waiting. I figure when you hit 100 people, I guess we'll get rolling here. So, all right, let's get started here. I guess the intros are probably less important for people that filter in. So, welcome everyone. This is debt financing in the cannabis industry. So, just gonna go through the slides here and introduce everyone. So, this is just a little bit about the law firm. We don't have to really get into too much detail here. Just about us. These are the panelists. I'll be turning it over to everyone, to say hi as we get to their slides. Next slide, please. All right, so FL at Harris Beach. Why don't you say hi?
Hello, good afternoon, or good morning, depending on whether you're an East Coaster or West Coaster. I'm with Harris Beach. I'm a co-leader of their cannabis industry team. Harris Beach has got about 200 lawyers focused primarily in New York State, Connecticut, New Jersey, and Washington, D.C. And I look forward to participating on the panel this afternoon.
Thanks, FL. And just, as background, so FL is a debt and real estate attorney by training. I'm an M&A attorney by training, but have been doing a lot of borrower side debt work recently. And then I'll let everyone else introduce themselves. So John for Valley Bank.
Yeah, good afternoon, good morning, everyone. John Meyer, Valley National Bank. I head up the cannabis lending group for Valley. Valley's headquartered in New Jersey with offices in several major markets across the country. Bank's been in business about 95 years, and over the past 3 years has really, rolled out a robust cannabis banking program, both on deposit and treasury, as well as some lending initiatives. So happy to be here and talk to what I've seen so far.
Great, thanks, Jen. Let's keep it rolling slide-wise. All right, so and I want to give Sahar a chance to introduce herself. Sahar.
Hi, everyone. My name is Sahar Ayinehsazian. I'm one of the partners at VS's Los Angeles office. I also co-chair our banking access group, do a lot of corporate work alongside Charlie, as well as figuring out all of the ins and outs of banking and potential cashless transaction options in the cannabis industry.
Great. Thanks. And just so everyone knows, because we're going to try and spend maybe 40 minutes on the slides here and then have kind of 20 minutes for questions at the end. So, toss in any questions. You'll get a copy of the slides if you signed up for this webinar. So don't worry if we don't get through everything, because we won't. I just probably went on the over-inclusive side here. And I guess just to quickly introduce myself and Vicente Sederberg, the firm. Charlie Alovisetti, I run the corporate group of Vicente Sederberg, based in the Boston and New York offices, but I was in Denver for 5 years before that. Our firm has 8 offices nationally, and we're very much focused on the national cannabis industry. And the corporate group is very focused on helping people execute on transactions in the cannabis space. So any kind of crossover between corporate deals and cannabis regulatory deals is our bread and butter. So overview of debt financing in the cannabis industry. Let's go. All right. Well, before we dive into that, I got to hawk my book. You can all pick it up on Amazon, give it a 5-star review. Okay, so debt work. Yeah, this is just about the debt work we do, and it'll give you kind of a little bit of perspective of what we're going to talk about here. We typically tend to be borrower side, largely because conflicts present a real issue with representing lenders, and we do represent lenders. Sometimes we're corporate, sometimes we're regulatory, sometimes we do both. We're happy to be pure regulatory counsel if you're another law firm that needs cannabis regulatory assistance. I certainly don't mind not chasing signature pages on a deal. Yeah, often we do, we'll come in to do local counsel opinions. We have a pretty wide range of bar coverage, and we're comfortable with the cannabis regulatory system, so we can be helpful there. We co-counsel where stuff's sort of outside of our sweet spot. So working with FL on a few deals right now on the real estate backside. And then last but not least, very happy to make intros to try and help deals get done. We're not brokers or anything like that. We're not trying to charge a fee. We just sort of make introductions, without making any reps about, having validated the deal or anything like that. So if you're a borrower looking to raise money, we can talk about kind of the stats that the lenders are going to want to know about. They're going to want to know what your collateral value is, what your revenue is, what your EBITDA is, what kind of licenses you have. And then, on the lending side, if you tell us the type of deals you'd look at, happy to send you which fits those parameters. We're not gonna try and pass on, junk. And we'll talk here about who makes a good candidate for debt, because obviously it's not everyone. So, why are we talking about debt right now? If you look at some of the numbers, and obviously this is tough because a lot of the industry is private, but MJ Biz is saying that 90% of the cannabis financing this year is through debt as opposed to through equity. Certainly on the public markets, there's been a lot of debt financing as well, partially because stock prices are compressed. So people don't want to dilute themselves through doing equity issuances. You got real estate lenders raising a significant amount of money. And then, last but not least, interest rates are largely a function of supply and demand. And because there's more demand than supply, we can talk about what typical interest rates are in this industry, but they're going to be high, and the terms may be, perceived as strict in some cases. Yeah, so I think just to understand the debt market for cannabis in general, I think you can think of it as two different debt markets. There's the one for the MSOs, and then there's the one for sort of everyone else. If you're a major MSO, obviously from a lender perspective, when you're trying to figure out what the risk premium on a loan is, it's going to be significantly less because look at the interest rate for GTI and its last debt financing. I mean, they're just much more likely to be there 5 years from now as opposed to a mid-sized player where there's a risk from the lender perspective that they may not be there to repay the loan. So this is kind of what we're seeing in terms of interest rates. Obviously, the MSO one, it's a lot easier to give you hard numbers because you can pull public deals. And we look at stuff like Viridian Capital puts out good reports on debt. And then the other players, this is a lot of this is just looking at term sheets we see. You're seeing mid-teens interest rates, but for both MSOs and for non-players, I think if you take away anything from this presentation, it's that the interest rate alone doesn't necessarily tell you the terms of the deal because there can be fees that are hidden in these deals. And there's also warrants a lot of times. So, if you're trying to figure out your cost of capital and there's 20% warrant coverage, that changes the calculations. So, and then, obviously the other players tend to be shorter terms because of the risk premium we were discussing.
Points are generally higher too, right? I mean, you can pay 5, 6, 7 points, the highest that you really see anywhere.
Yeah, and we'll talk about those hidden fees in a second, so you kind of understand what you're getting into. So next slide. Yeah, so these are the kind of the hidden fees, and there's a lot of terms you should familiarize yourself with if you're going to talk about debt. I mean, the big one is original issue discount. Look it up on Investopedia. It's probably going to give you a better definition than I will here off the fly, but you got to factor that into your calculation. So if someone's offering you a low interest rate, but there's significant OID, that means they're not going to fund the full amount of the loan. They're going to fund the loan less the OID. So if you borrow $100 with the 10% OID, you're going to get $90 at closing, but you're going to be considered as if you borrowed $100 in terms of your interest payments and the principal that you need to pay down. But there are other fees that banks put in place here, and then obviously I'm not trying to be anti-lender here, because the reason these fees exist is because these are high risk loans, young companies, difficult industry to understand, and then obviously the big picture in the background here is that there's no federal bankruptcy. So transferring licenses is a bit of an X factor. I mean, you can look at public deals like the Ayinehsazian transaction with Gotham and see how it plays out in real time. But the lenders are taking significant risk on here, so they need to be compensated for that. So, a commitment fee there can be fees just for making the loan. There are oftentimes deposits just for entering a term sheet. Double check that. You're often going to be paying for the bank's legal counsel. So, definitely talk to a lawyer before you sign a term sheet, because there are parts of these debt term sheets that are binding. Monitoring fees, just to monitor the loan. Revolver fees, if you take on a revolver, if you don't draw it all down, there's oftentimes a fee for that. Payment in kind, it's just, this is where, you just add the interest you would have paid back onto the loan. Warrants, which is just, an equity kicker here, where they're going to take an equity position in the company, again, to compensate them for the risk. And then equity financing requirements. So a lot of times, if you're talking about a construction loan or a loan to sort of an early stage company, the bank's going to want to see you put in a certain amount of capital to the company, raise it on the equity side, so they're not carrying the entire burden themselves. And then last but not least, just if it seems too good to be true, it probably is. So, take a hard look at this stuff. Next slide. I'm just gonna speed through these, but this is just, you gotta calculate the effect of the fees on the interest rate. Different types of deals here. So, we'll talk about sale leaseback in a bit with FL, asset-based lending, convertible notes, medium-term notes. We don't really talk about factoring, invoicing here. I mean, what we're kind of focused on here is just your kind of standard kind of term loan, but obviously there's a bunch of different permutations here. These are kind of the people that are going to be out there. The REITs, there's a bunch of these guys that are publicly listed. There's listed funds, a number of people on NASDAQ now, like for example, AFC Gamma. Private funds, this is still probably, I would say, the bulk of the financing in the industry. People set up basically as private equity funds that are investing in the industry. And then, real estate investors, which is kind of a catch-all, like high net worth real estate investors, just people who are investors that are looking to play in the industry. And I say real estate because I think real estate people historically put a lot of money in. They're kind of hard money lenders. They're just more comfortable with the risk.
And Charlie, one of the providers missing here for obvious reasons are, your traditional banks. I'm not sure, don't quote me on this, but I believe nationally, there's something like 500 banks in the cannabis space. 98% of those are going to be credit union or very small state chartered banks. And that's what most operators are facing. There are at least two more medium mid-sized banks that we know about, which is Valley Bank out of, primarily out of the Northeast with offices in Florida, Alabama, Chicago, LA. We're about a $52-55 billion bank. And we know of East West Bank on the West Coast. They're also about a $60 billion bank. But, in investigating this industry for a couple of years, a lot of the larger companies, what they need, they can't get at a smaller bank. So they're going with these REITs and these other options. And that's why Valley entered the space when we got comfortable with it, because there weren't many players in the space offering loans of our style and type. And, we will admittedly take a much more conservative approach to lending in the industry than a lot of options. But for that, the pricing, being fees and interest rate, will be much more reflective of a commercial conventional bank.
Yeah, and I should throw in like a lot of sort of the, kind of the regional focused banks here that are, providing depository services often will be very wary of lending to people that aren't existing customers of the bank. So those tend to be long-standing relationships that, you should probably get started on building in advance. And then even and like I'm a little bit over my skis here, but even looking at the Canadian industry, there hasn't been a ton of bank lending, traditional banks. I think that's also because they haven't done as well as they hoped.
And let's face it, Charlie, conventional banks, are looking at the risk profile and they're saying, well, hey, the amount of investment we'd have to make to get comfortable here to charge our standard style interest rate, the risk return, I think to a lot of banks of size just isn't there. And what Valley and what I'm guessing East West Bank saw is a void where if you did spend the time and money on it and found a way to do it, we're not for everybody. We're for, established operators that have a bit of a track record. At the end of the day, it's not rocket science why Valley's in the space, because we're not doing all that much different than what we would do for a standard traditional operator, right? Whether you manufacture widgets or package food, we don't have all that different of a program for the cannabis industry, in the sense that we're still looking for people that have recurring cash flow, sustainability in the market, a track record, right? So we wouldn't necessarily bank a startup that's packaging food. We're probably not going to bank a startup that's, cultivating or dispensing cannabis. So there is a place for Valley, but it's not for every operator. And being in the space long enough, I've seen, as you can imagine, a slew of companies that are just not in their life cycle ready for conventional financing. And that's why you have so many REITs and private funds that are there to make more money on that risk and, take the upside. So it is a very segregated market with, your options for debt. And, unfortunately, there's a lot of people or institutions that are taking advantage of the lack of available funding and are, almost treating it as predatory. We've talked to a lot of companies that are either currently in a position that they're, subject to more of a predatory environment, or coming out of that and saying, well, now we've reached, sustainable EBITDA and cash flow and can maybe justify, less expensive financing. So as everyone on this call knows, it's just a ever evolving daily progression on this industry.
Yeah, so it's saying, like, just so you understand, again, coming from, as a borrower, you got to think about this from the lender's perspective. There's a lot of risk here, and they want to protect themselves as much as possible. So that's why you got to think about, they're going to want all asset liens. You do see personal guarantees in cannabis where you wouldn't see it in other industries, though, on the sort of traditional mid-market deals, like in cannabis, I'm not seeing PGs. You got to pledge the equity of your businesses. Obviously, everyone's got to understand that that's, you can't necessarily just execute on that. It's all subject to regulatory approval. And then financial covenants and reporting, which is, my big message for borrowers here is that, before you sign one of these loans, just understand what your ongoing obligations are, right? From a financial covenant perspective, from an affirmative and negative covenant perspective, because you don't want to set yourself up for a potential breach. Yeah, these are just sort of like often, ongoing obligations. We don't have to get into the details here, but those are the financial covenants, which are, maintaining a certain amount of free cash flow, et cetera. So, like, let's talk about what you want to have here to be a real candidate.
Charlie, can I add one
please.
point on the financial covenants? Depending on your role in the transaction, I mean, if you're a lawyer for the borrower, or the representative of the borrower, I would make sure that the CEO and the CFO totally understand the financial covenant and model it out, and make sure that they're not going to have any issues with the way it's framed in the loan documents.
Right. Yeah.
You pass by those and could be problematic.
Yeah, it's a team effort. It's like the CFO, the accounting team, the lawyers need to work together to make sure everyone understands the covenant package, and that it's realistic that you can maintain it going forward. Because if your revenues decline next year, you don't want to be in a position where, oh, I just breached the financial covenants, now I'm in default, now I could lose the company. But big picture here is like, yeah, these are for existing cash flowing businesses. The startups, the ideas of the world are probably not going to find debt. And you really need to have assets that they can secure the loan with to get comfortable. If you don't have, sometimes they can get comfortable in the licenses. Typically, they prefer real estate. But, again, if it's a profitable business, the real estate becomes less necessary. But it's all risk calculation for the lender here.
Yeah, Charlie, we've seen a lot of deals, where the REITs are able to accommodate a loan where they can rely on a mixed valuation of the enterprise value, the license value, throw the real estate in there, maybe some equipment, et cetera. It's almost like a blended value. And again, you're going to get an interest rate reflective of that mixed bag of risk. Whereas, more of the conservative conventional banks like Valley and others, whether big or small, if they're in it, they're really only looking to the real estate available, which I think, and we'll probably see a slew of comments and questions on this. It makes it very tough for a startup or a smaller player that doesn't own real estate to get financing, which is probably why you're seeing so much private money go into the space, because they're either going to take a chunk of the business or they're going to make, a pretty decent premium on the fees. But it is a challenge. I mean, look, as a conventional banker, I've been a banker in commercial, commercial and industrial companies for 13 years. This is unlike anything I've seen because it's state to state. It's not just some industry like, hey, this is a transportation company. Well, what do those look like across America? This is an industry that's defined by each state. So, it's a very tricky thing. And I've questioned how some of the smaller players that get licenses are going to manage, because how do you get financing if you have no track record and no assets to speak of, and you're trying to launch this thing? Well, you're probably going to be forced to take higher priced money or give away equity, right, Charlie?
Yeah. Obviously right now it's difficult to raise equity. It's the unfortunate reality. So, again, positioning yourself to take debt, it's really about having that collateral that you can offer to lenders so they can get comfortable. And it's about being, having cash flow. There really no magic there. Next slide. All right. Okay. So I'll turn it over to FL for sale leasebacks.
All right. As far as collateral, well, the collateral can be the land and your mission critical facility. And, just to break it down very simplistically, you own the property, you find a REIT, a private investor, you sell the property to that buyer, and then you lease it back. And you pay the buyer the rent. And it's a way to extract some equity out of the property. In these leases, they're net lease deals. The net lease market is a huge market in the U.S. It was in 2021, it was almost $100 billion. And the investors in the net lease market, they might be institutions and REITs, high net worth individuals, family office, private real estate equity, and then some tax deferred investors. You don't quite see that so much in the cannabis industry, but with other with other sale leaseback transactions, there's a way to do those with some tax deferral. The investor buys the landlord's interest in the lease and essentially purchases the rent stream from what was the seller, who now becomes the tenant. Some fundamental terms with sale leasebacks. You have triple net leases where you're paying all costs of operation, but a lot of these sale leaseback deals are actually absolute net leases where you're the tenant, and aside from paying the taxes and the utilities, you're also responsible for the roof and structure. And then in some cases, even if the property burns down, there might be some rent abatement, but you still may be obligated to pay the rent on these. This is very popular, 10 or 15 years ago in the CVS and the Walgreens of the world. They were exploding onto the scene, and people would buy their rent stream. And a lot of times that rent stream would include the construction costs for the building. A lot of the real estate investment trusts are, in this area. REITs are popular as an investment vehicle if you want to invest in a REIT because they're obligated to distribute a high percentage of their net revenue, generally around 90%. And then on these real estate deals, cap rates end up coming into the equation. The capitalization rate is a traditional way to value real estate. You look at the net operating income of the property and you divide it by a capitalization rate. Generally, the better credit, the lower the cap rate. For example, I have a McDonald's example in here, $100,000 ground rent, with a 4% cap rate, the landlord could sell it for $2.5 million. The cap rate comes into some of the analysis when you're underwriting these deals as sort of a check on the rent that the seller tenant is paying to the investor. Some of the key provisions in a sale leaseback transaction, you have the base rent, and that's, you're going to need to do some sort of fair market rental analysis to make sure, you're in line with, with your particular property type. The term of the lease, often the sale leaseback terms can be 15 to 20 years. Rent commencement, a lot of times in a traditional lease, you might have some free rent period. In the sale leaseback, the rents commence right away. Often they do want guarantees, a corporate guarantee, because the creditworthiness of the tenant is very key. They will have some financial reporting requirements, but primarily they're looking at the rent stream. Casualty condemnation, if the property burns down, the landlord's going to want to control that. Sometimes subleasing and assignment, those are big issues. Subleasing, I've seen that the landlords don't mind that as much as long as the original tenant remains on the lease. Assignment, they get a little more nervous about that. It's got to be a credit-worthy tenant. In the case of the cannabis industry, the issue with the assignment is whether or not you can also, the assignee can get, whatever licensing he needs to continue to operate the property. Environmental, the tenant's responsible for all environmental issues at the property. Roof and structure, a traditional lease, often landlord's responsible for roof and structure. In a sale leaseback transaction, you're going to be responsible for all that. Capital improvements, as we'll talk about in a little bit, that they will, that the buyer of your lease will often maybe reimburse you for the capital improvements. If you need additional capital improvements, maybe they'll do a lease amendment that will have rent increases that go along with, the payback for that capital improvement. Renewal options, you probably want some renewal options. And then the question is ownership at the end of the term. Generally, you won't own the property at the end of the term because that will have some negative tax consequences. The companies out there that are doing the sale leasebacks, the underwriting criteria, they're going to look at the tenant management team. They want to make sure, they've got a fully built out team. The team knows what they're doing. And they've got experience in the area, and they have their, a CFO, a CEO, director of construction management. And that's going to make a big difference in the underwriting. Tenant's capital position, the tenant's going to have to raise some capital on its own, and is going to have, some backbone, financial backbone, so that it shows that it's got a good chance of being successful. So they're going to look at that equity raise. Financial results, often what they'll do is they'll look at the prior financial projections and assess those against the actual financial projections. And then they'll look at the operational footprint. If this is a one-off tenant, one-off sale leaseback, it's going to be a little bit harder, or a lot harder to do than if you're, like in Texas, let's say there's, 3, vertically integrated cannabis companies. One of those, I think, sale leaseback would be good because you essentially dominate the Texas market. The use of funds. Go ahead.
No, please.
Okay. Use of funds, they'll use it for, acquisition. They'll often, reimburse you for your acquisition costs. The build out costs, I think they're going to focus mostly on the hard costs, like the site work, electrical, gas, utility enhancement, security systems, water wells, portable water, versus the soft costs. Much more likely to reimburse you for the hard costs and the soft costs. And then for expansions, if you're going to be expanding your property, For the construction draws, they're going to be very detailed. They're going to want sign-offs by the general contractor or the architect with supporting invoices, lien waivers, releases from the subs. Often they'll require a general contractor's affidavit, just, proving out exactly where they are in the construction project. Some benefits in sale leaseback versus traditional debt financing. Typical debt financing can be 10 years or less. The sale leaseback, you can have terms up to 20 years. Arguably, you unlock more value. Typical debt financing, 65%. Sale leaseback could be up to 100% of the property's value. The seller tenant may have more room to negotiate lease terms than they do in the debt documents. The seller tenant is going to retain more control over the property than maybe what's provided in debt documents. There's going to be a lot of reps and warranties in debt documents, and more than certainly what's found in a lease. And then in the sale leasebacks, the tenant's going to have some tax savings. They'll be able to write off lease payments as an expense. Property owners generally only have tax deductions available for interest expenses and depreciations. And then the financial covenants generally not found in a sale leaseback. And as we talked about earlier, omnipresent in traditional financing. In the sale leaseback market, there was a big class action lawsuit that was filed at the end of April against Innovative Industrial Properties, IIPR. It's in federal court in New Jersey. Class action security lawsuit. I think this is going to be one to watch because it's going to definitely affect the amount of proceeds that you can pull out of your sale leasebacks. The essential allegation is that IIPR is not a REIT, but it's a disguised cannabis company lender. And that the true values of IIPR's properties are a lot lower than the company represented. And then, there's some existential issues with some of its top customers. In the lawsuit, they reference Parallel, which is in several states, I think Florida and Texas, and then King's Garden. They were, big. They were a large percentage of IIPR's portfolio, and since the lawsuit was filed, King's Garden has missed their July payment, and Parallel, I think, is subject to an investor lawsuit. So, so I think that's going to be something that's going to affect the sale leaseback market. IRPR did respond. The lawsuit was as a result of a report by Blue Orca, which is like a apparently well-known short seller, and essentially, IRPR has argued that Blue Orca failed to appreciate the mission-critical facilities that were subject, that are part of their loan portfolio, and we're waiting to see the IIPR's official answer is going to be due in the next couple of weeks. And it'll be interesting to see, where they, how they come out on that. As far as the underwriting case studies, we talked about that a little bit and the material that we have. Parallel was one of their big operators. They had a huge footprint, 22 licenses in Florida, 2 cultivation properties, 44 dispensaries. In Texas was one of 3 vertically integrated license holders. Had a great management team. They raised $300 million in private capital. But, unfortunately now Parallel is subject to a lawsuit. And then King's Garden was using money for acquisition, but also for project improvements. King's Garden missed their July payment. IIPR did blame in part California's current market dynamics as far as the taxes being too high, and the legacy market there is arguably just crushing the legal market. And that's my quick breeze through sale leasebacks. And
Thanks,
had
FL.
a good ride.
I'm gonna turn it over to Sahar to sort of. There's a lot to cover here. If you want to there's a lot here, but to just talk about regulatory considerations here, because it's again, as everyone knows, it's a pretty heavily regulated industry, and some of those regulations do impact structuring debt deals.
Thanks, Charlie. So with respect to the cannabis industry, as John mentioned earlier, it's very much a state by state and sometimes locality by locality patchwork. So as you're considering all of the more traditional sides of a potential transaction, it's also important to, at the same time, really consider the regulatory issues that you might have to figure out, go around, discuss with your lenders and whatnot. For Massachusetts, and really I would say for every other regulated state in the cannabis industry, first and foremost, it's really important to speak with your counsel regarding, as a lender, regarding risks that you may have lending to cannabis and cannabis related businesses, risks of loss, risks of disclosure, any other issues that you might want to consider. It's also really important to take a look at the FinCEN guidance from 2014 with respect to cannabis banking, as well as where the DOJ's stance is, what its enforcement priorities are with respect to cannabis businesses, because that may be something that will shift your risk tolerance somehow. It's also important to think about your own expertise and abilities with respect to anti-money laundering and BSA knowledge and abilities, and whether you have to abide by any of that with respect to lending to cannabis businesses, and if it is something that you are able to do. Also think about what the cash management capacity and security issues are with respect to cannabis and cannabis related businesses. Those do sometimes tend to be heightened risks, so something to keep in mind. And then also the reputational risk. The cannabis industry has come a very long way from where it was with respect to the war on drugs. It's obviously looked at as one of the economic bases for a lot of states, and it's looked at as a far more respectable and reputable industry. But there are still those who look at it as riskier and a little bit more, not something quote unquote normal. So think about how that might affect an existing customer base. And really importantly, think about what to do if you decide to no longer serve MRBs, how you're going to manage that exit, how that's going to affect you, the timeline for that exit, potential risks with respect to that and whatnot. And then also there's the FinCEN's Resource Center where you can go to ask more about federal guidance. Next slide, please. Really important to remember that in the cannabis space, federal bankruptcy is not a possibility for plant-touching cannabis businesses. So whereas a normal, non-plant-touching business would be able to relieve itself of its obligations when things get really bad by going and seeking federal bankruptcy protection, that's not a possibility for plant-touching businesses. And so this is something to keep in mind at the very, very start, to think about what's going to happen in the worst case scenario, what is possible and what's not possible, and how to create a plan around that. So some regulatory considerations for borrowers that I think should be thought of at the very, very start when borrowing debt financing is just even an inkling in one's mind. Do regulations require disclosure of the loan? It's important to figure out whether you have to just disclose the loan, whether the loan has to be approved, what the timeline for disclosures and approvals are. And if you're working in a multi-state arena, you need to think about every single state and really line up the timing for every single state of disclosure, of obtaining approvals, of the steps and what that may look like, because that might actually play into how your transaction maps out. It's also important to take into consideration each applicable locality's requirements with disclosures, because sometimes localities don't always line up with the state requirements. And so you might be doing everything that the state wants you to and somehow tripping up local requirements. And that's just not something you want to do. Also think about whether your lenders are subject to background checks. And if so, who within the lending entity is subject to background checks. A lot of times you'll, go forward, the term sheet looks great, you figured everything else out, and then all of a sudden you realize your lenders and the principals of your lenders need to go through background checks, and that's not something that a lender wants to do. And that's something that you need to figure out first and foremost, because if your lenders need to be disclosed, or if they need to go through background checks and they have no interest in doing that, that's obviously going to hamper your transactions. And then thinking about whether there's restrictions on loan collateral, specifically with respect to collateralizing a license, the equity in a licensed business, and the inventory that a business holds. A lot of states tend to be kind of silent on this. There are a few that have restrictions around it. When you are collateralizing a license and equity or inventory, it's important to think about whether your state, for example, allows for licenses to be transferred as an asset, whether someone holding any kind of interest in your equity needs to be disclosed. And then, of course, inventory in a cannabis business, cannabis and cannabis products specifically, generally can only be handled by someone holding a cannabis license, so something to also think about. And then consider what the types of covenants or control are allowed in your state. A lot of states tend to be kind of silent on what control actually means, but you want to be really careful in understanding what might trip up control issues, because that in turn may create the need to have additional disclosures, have additional regulatory approvals where you otherwise may not have had to. And then thinking about if you become insolvent, the collateral has to be collected upon, what actually happens? What does that look like step by step in the regulatory process? Can a lender just come in and take control overnight? Do they have to be approved? How does that work? Again, thinking about the timeline for that. And then part and parcel with that is receiverships and assignments for benefits of creditors. Certain states like California, for example, actually include receiverships in their regulations, while other states are just kind of silent on the matter. Important to figure out what the process of receivership actually is, because when that plays along with cannabis rules, as including background checks and approvals that are necessary, it may not look like what a traditional receivership would look like. So it's really important to think about what, again, the timing for that is, what the approval process, what the disclosure process for receivership or assignment would be. And then just kind of tying this all up, again, what are the timelines? What are the procedures for change of ownership in case your lender has to come in and collect on the collateral? Really important for everyone to be aligned on that right off the bat.
Thanks, Sahar. So we've got 50 minutes left, so let's open up to questions. I guess I'll start going through here and throw in this group some questions. All right, let's see here. All right. Global. Is being in the cannabis business an impediment to obtain from the federal government a global trust traveler membership? So, global entry. It's a good question. I don't think so. Sahar, do you have global entry?
I think I do. So generally, what I've seen is that it's not an impediment, but like all things in the cannabis industry, it's important to remember you're entering a federally illegal arena. And even if the federal policies are more lax one day, they may always be subject to change.
Yeah, so I don't know if there's any guidance on this. I will say, so it can impact your immigration status. So that, there is guidance from the federal government saying that, if you're working in the cannabis industry, that is not something that they view favorably from a naturalization perspective. So it's not a job I would recommend for someone who's on a green card in the US. And then there are also issues in terms of entrance into the US, but that's typically more of an issue for people that are non-US citizens. They can't really deny you entry into the US if you're a citizen, but if you're a non-citizen traveling to the US for cannabis business, you can be turned away, and people have received lifetime bans. Let's see here. Yeah, do you see taking on debt making sense for ancillary brands just starting to get into the market? So the short answer is probably not. You probably don't have the collateral base or the cash flow that's going to get a lender comfortable with the deal. I think you're probably going to have to go with equity financing. Again, if it's a brand that has, maybe you own a license or 1 in 2 states and you have facilities in those states, you actually make your products in your home state, and then you just have IP licensing deals in other states, that might be doable. But just your typical brand that's just got white labeling agreements is probably not going to be possible. Flexibility. Let's see here. How active is the lender refi market, especially in light of stress building in certain markets? I'll turn this over to anyone who wants to answer it.
I think it's fairly active. It's going to depend on the market and, what the saturation looks like. Has it peaked? Is it still stable? Is it on the downswing? But at the end of the day, real estate in the cannabis world is pretty interesting because there's such a significant investment made into the property that is specifically translated to a cannabis company, whether that's HVAC, lighting, irrigation, security. It's a substantial upfit, even in dispensaries with, various security and CapEx. So what you're seeing on a valuation from an appraiser would be, if it were trading as a cannabis property to another cannabis property or owner, it would be worth X. And if it were a cannabis property, but you were looking for a non-cannabis company to buy it, it would be trading at Y, which is usually significantly lower. So, conventional conservative lenders, somewhat like Valley, are going to steer closer to the non-cannabis value. And for that matter, for this question, we're just as active as any other particular real estate deal, right? Whether it's an industrial or retail, we would look at it. Well, what's the industrial market like in that area? What's the retail industry like in that area? But it's like there's 2 ways to skin this cat between the cannabis valuation for cannabis users and then the non-cannabis value. So overall, I'd say it's just as active as any other real estate market.
Yeah, I'm working on a couple of refis right now. Time will tell, though, right? It's that's why something like this is so difficult to give, clear guidance on where the market's going, because it's so fluid right now. And if you know where the stock market's going to be in 6 months, let me know, because that's useful information.
Yeah, it's funny, Charlie. There's no broad stroke answer on anything in this industry. It's all, well, that depends.
Yeah. How does a client find insurance? Yeah, there are plenty of insurance brokers. We can, if you reach us, we can provide referrals there. Let's see here, brokerage. Yeah, counsel. Yeah, reach out if you want to chat about REITs. Yes, work with financiers and partnerships. Yeah, there are construction loans. Have worked on a number of construction loans in the industry. I think, what FL was talking about when it comes to the,
Sale leaseback.
Leasebacks, I think, is probably the most applicable to that question. I think that, just, again, the question's about the collateral value. So, I don't think someone's going to fund a construction loan for a brand new company unless there's significant equity value in there, because then they're not going to have enough coverage for their loan.
Yeah,
So
Charlie, one of the things I've kind of trained myself to think about, and I think would be applicable for most people on the call, don't lose sight of traditional lending metrics when it comes to cannabis specific, right? Because although cannabis is kind of this massive gold rush and there's a lot of upside and there's a lot of money to be made, lenders are still looking at it through generally traditional lenses, like you alluded to earlier, Charlie, where is there cash flow and is there collateral? So if you're building a building for food production and, you're a startup, it's going to be just as hard to get traditional financing than if you're a startup cannabis company. So you just have to like retrain your brain to think, yes, it's cannabis. Yes, it's limited license and there's all this value, but to obtain, attractive financing, it's still going to look pretty similar to other traditional business lines.
All right, here's a question I think we can.
Excuse me, I did do an analysis of IIPR's investment volume, and 52% of it was for basically construction loans and property improvements. So, and then as part of the sale lease back, they would do a lease amendment. So that may be one way to find a construction loan.
Yeah, here's a question I think I can answer easily. It seems if you have institutional preferred equity, that the type of loan terms will a call on the equity will not fly. And I think by this, they're talking about like you're not going to be able to get a pledge. The private equity investors will not pledge their equity to the lender. Are equipment financing the only available option? So this is an important one to think about because this is kind of a structural issue that you may need to set up in advance of a loan. So most lenders are going to want you to pledge 100% of the equity of a holding company that owns all the assets. But that holding company doesn't need to be your top holding company. So a lot of structures will involve a top co that's got, preferred investors in it, an intermediate co, which is 100% owned by the top co. And then under that intermediate co, all the operations. So it's easy for the top co to pledge 100% of the equity of that intermediate co to the lenders without having to get the investors to sign off on the deal. Now, in a typical preferred deal, you'll need to get consent from the investors to do that pledge, because typically taking on debt financing will require approval of the investors in a typical kind of Series A deal. But it makes it much easier and the lender's going to like it because you can just give them it's usually an LLC. So they know they can just take that LLC subject to regulatory approval and they're going to own all your operations. So this is something where, and we didn't really talk about it in this discussion today, but if you're going to take on debt, figure out your diligence ahead of time. So, look at your structure, talk it through, make sure you got all the documents in a row because I've seen this happen a few times where there's no intermediate co and they get to closing and the lender's like, all right, well, pledge all your equity. And you're like, well, I can't get my investors to pledge their equity. And then you have to sort of do a reorg on the fly. It's better to do that in advance. All right, let's see what else. How does the creation of a SPAC like Safe Harbor Financial recent developments affect the lending environment? Who wants to take that one?
I'm actually unfamiliar, Charlie. Sorry.
Yeah, so Safe Harbor is a they've been active on the depository side for a long time, and they just recently did a SPAC. I mean, my view is it's a positive for the cannabis industry because it's supply demand, right? It's going to increase the amount of capital that could potentially be supplied to the industry in the form of debt financing. So it's beneficial to the borrowers because it will hopefully bring down the cost of capital.
And it was primarily the Colorado Credit Union previously, and they just announced, Safe Harbor just announced that they've done their first loan outside of Colorado. So
yeah, I think they did it in Massachusetts, right?
Okay. Yes. Yeah.
All right. See what else we got. Here's, what type of metrics targets at Valley do you typically need from a company? So I imagine John's going to say it probably depends, but my 2 cents would be like, you got to think in terms of coverage. You want to be generating enough capital so that, one, if the loan goes south, the lender's not going to take a bath. And then 2, you've got plenty of cash flow to support whatever interest payments you need to make. So that's my take. It's like, depends on how much you're trying to borrow.
Yeah, I agree. It's not overly different from our traditional metrics that we would look at any, traditional operator. So, we're going to have minimum debt service coverage requirements. They're probably going to be slightly higher. If your average company needs to show 1.25 times, we might want to see at least 1.5, if not 2 times coverage. Again, because if you are an established operator in the space, you are typically generating above traditional company cash flow. We don't want to see companies that are over levered, just like we don't want to see companies over levered in any other line or industry. And as kind of beating the drum again, it's collateral and cash flow.
And I would also say that a lot of these alternative credit providers, the larger players, they need to make loans of a certain size. They're probably, it's like call it 10, 15, 10, $5 to $20 million, because if you think about it from their perspective, you can't make $500,000. You can't make a ton of $500,000 loans, right? Because it just doesn't make sense for you financially, and it's too difficult to track. So if you're looking at an alternative credit provider, you can typically figure out like what the size loans they've done historically.
Yeah.
And then, your metrics need to match up with that amount of money, because they're probably not going to lend you, if they've been doing $5 million deals, they probably don't want to do a $300,000 deal, and they probably don't want to do a $100 million deal.
Yeah.
All right. How do you see IPOs happening in the space? Will it be all large MSO or some strong SSO too? Well, I guess on that one, and this is another kind of tough question for someone that's not an expert on the public markets. I think the demand for cannabis IPOs is probably not super strong right now. Just look at the pressure on the equity prices of the big players already. It doesn't seem like the market is demanding new cannabis issuers. So I think it's going to be pretty tight for the foreseeable future. You're also not going to be IPOing in the US anytime soon as a cannabis operator. It's going to be on the CSE up in Canada. All right, we've got one question here. All right, let's see what else we got. Yeah, I'll have to follow up on the equipment financing. I don't have those numbers at the top of my head right now. We may do something separately on the equipment financing side.
I've seen some equipment financing in the space, Charlie, as I'm sure you have.
Yeah.
It's out there. There are companies doing it. I would imagine it's not dissimilar to the mortgage, the real estate market, where it's going to just be higher priced, maybe slightly shorter term.
Yeah, here's what I've started several specialty fincos catering to lower middle market. How do you see structures differing for lower middle market borrowers more than middle market companies? And isn't most of cannabis lower middle market? Yeah, I think that's a fair statement. I guess you can debate what middle market is, but I think, what do people say, like revenues up to $1 billion? So obviously that captures, that's the cannabis industry right there. It's certainly on the lower side of the middle market. I do think that that's kind of what we're seeing earlier. We were talking about is like the kind of people, the alternative credit providers that are focused on the cannabis space are expecting more hair than your typical middle market lender, because there's hair on all these deals. It's just kind of a matter of like, what's, can you live with it? So I think we're at 2 o'clock here. So I want to thank my panel here for their time. And thank our intern, Will Denny, who helped me a lot on the slides. Shoot us an email, any of us. We're going to send the slides around. Look forward to talking. I know some people reached out about connecting. I'm going to reach out. But thanks everyone for your time today.
Thanks
Charlie.
Everyone.